Like I said, I have vast experience with this module. I have taught it from 2013. Every semester, we have produced the great results. So I'm very sure that you guys, you really benefit from this session. We are going to try to take it easy so that everyone can be able to understand what is going on. Right. So I'm going to start with risk and return. So to just talk about the learning outcomes, we hope that everyone by the end of the session will be in a position to be able to define what is risk, to define what is return, and also to understand the relationship between risk and return. And also you should be able to tell us what is your risk preference. We'll discuss about what we call risk preference. So maybe at the end of the session, if someone can just tell us what do you think, which preference do you think you are on, right? We'll discuss different types of preferences. Yes, Shani? Teacher Shan.
Could you grant us permission to record this lecture, please?
Okay. I'm gonna just quickly check from my side if I can quickly do that. Unfortunately, the permission that is there, it's only to allow participants to share screen, chat with, rename themselves and unmute themselves. There is no an option to allow participants to record.
No, I will allow them from my side. I'm going to allow each and everyone to record.
Okay, cool. Thank you.
Thanks a lot.
Right, so then we'll also look at the issue of a portfolio. We'll look at a single asset, then we'll also look on a portfolio. Then we'll look at expected return. Then we'll go into the measures of risk, that is your standard deviation, your coefficient of variation, then also your variance, right? Then we'll also look at, let's say you do have two assets and you're supposed to choose one out of the two using the risk that you have calculated and the return that you have. How do you make a decision based on that, right? If you have two assets with similar expected return, how do you choose the best one to go with? And we'll also look at a situation where you do have two assets and they have different expected returns. So how do you make your choice? We'll look at that as we go. Right, before I proceed, I go to the next slide. Can someone just tell me, what do you think risk is and what do you think return is? If you can just have one student to quickly try to tell us what you think a risk is and what you think return is. Okay, I'll go for it myself, right? Okay, so when you talk of return, just think about when you invest. You guys, I know some of you have bought some bonds with government, some of you have bought shares in different companies. But if you have to think about what you consider to be your return there, or what you have benefited from the investment, you normally look at the price that you bought the share at. Then you also look at whether you were being given interest over the period or you were paid a dividend, right? So my definition of risk and return in this case goes like, it is the total gain or a loss experienced over a given period of time, right? So it is the total gain. Guys, can we please try to mute our mics, please? Okay. Return is the total gain or the total loss. So return is not only when you gain something, but it's also when you lose. We measure it as a return. So if you invest in a company that is shares that are currently running for, let's say, 20 Rand, But tomorrow the shares are now going for 18 rand. So your return is a loss of 2 rand. So a return can be either a gain or a loss, right? I'm going to just quickly use an example of something that UNISA likes in their exams. So I have an example here that says on 10 January 2018, you bought AfroSolar shares. AfroSolar is a company that supplies solar systems in Johannesburg for 67 rands. And on 31 December 2016, AfroSolar shares are now trading at 74 rand. And the dividend paid by AfroSolar to its shareholders amounted to 3 rand. I know in your textbook you have a very big formula that is there. But guys, I just want you to understand something. When I taught this module for the past 7 years, when people come a day before the exam, we tell them, no, forget about any formula here. Let's just conceptualize everything, right? So that's what exactly we want to do. Right, so return, you always express it in terms of what you actually put in. So let's look at our return in this case. So the shares were going for 67 rand, but now the shares are going for 74 rand. Before we even look at the dividend, it just shows you that your investment increased from 67 to 74, right? So if I'm to look at this, I have 74 minus 67, right? Okay, which is an increase of that's 7. So there's an increase of 7 rand in the value of the shares. So there's an increase of 7 rand, right? Then on this, in the same year, AfroSolar paid its shareholders a dividend of 3 rand. So there's a dividend of 3 rand that was paid also. So on top of this capital growth, so this one is more like a capital growth, right? Because you invested 67. Now the same share that you invested 67 rand in, it's now going for 74. So there's a capital growth there. But there's also a dividend of 3 rand in that same year. So if I take my 7 rand plus 3 rand, I get a total return of 10 rand. Right. But the question is, how much did I invest initially? I had invested 67 rand. So if I want to get the return as a percentage, it's 10 rand divided by 67. Then you get 10 rand divided by 67. Then you get a return of 14.93%. So if you're asked for a return, you're given the prices of the shares, you always need to look at the price. So your formula says return RT, then it says you need to look at the price PT, right? Then you subtract the PT minus 1, but this is what I didn't want now. I'm not going to go that way. Everyone is going to get it using without any formula, right? Right, so basically what I said here, you look at the capital growth. So in this case, I will say 74 minus 67. Then that will be added to the dividend that has been paid, which is 3 rand. Then you divide by the amount that you invested, which is 67 rand. Then you multiply by 100. Then you get your return as 14.93. Anyone with a question so far before I move on?
Yes. The dates, it says on the 10th of January 2018, and then it goes back to 2016. I'm a little bit confused.
Thank you so much. I didn't, that is 2018, right?
Okay.
Thank you for that question. It's a very good question. So basically, it's 10 January 2018, then 31 December 2018. Sorry about that. Thank you so much. Right. Anyone with a question? Right. No, any other question?
One more question. if it was reversed, that you first bought at 74 and then it decreases, do you still go? Would you go 74
Can I
minus
just quickly?
60? Yeah.
Yes, let me just quickly do something now. I'll show you now what you're asking. So, like what she's saying. So, let's say the share price was used to be 67 rand, but it now went down to, let's say, 65, right? Do you want it like that? Right. So if it goes down like that, so there's a decrease in the value of the share. So if you want to get the return, you still do the same. So you'd say 65 minus 67, then you add the 3, then you divide by 67 rand, then you multiply by 100 over 100%. So basically what you now have here, it's 65 minus 67, that gives you 65 minus 67, it will then give you a negative 2. Then that negative 2, you then add it to the 3 plus 3. So you realize that the net gain there, it's actually 1, because if you say minus 2 plus 3, you end up getting a 1. Then that 1 you divide it by the original price, that was 67. Then you multiply by 100. So it will be 1 divided by 67. Then the return will be 1.49%. Is that clear?
Yeah, that's
Yes.
clear.
Thank you.
Okay, thank you so much. So we'll move on now. So that is how you calculate a return. So whenever a question gives you the price right at the beginning or at whatever point, then it gives you another price at a later stage, maybe after a year. Then they tell you the amount of dividend that was paid during the period. That is how you calculate your return. You just look at the difference between the prices, then you also add the dividends, right? Then you divide by your original investment. That will be the price at which you bought the share at. Okay, so I'll quickly move on so that I'll correct that before we share with you the material that we'll be using, right? Okay, then okay, so I'm going to quickly move on now. Risky preference. Right, this one is very, very important. You need to understand the types of people that are there and what they like in terms of return and in terms of risk. So it's not everyone who likes the risk to be very low. Hence, you realized that when some pyramid schemes came into South Africa, some people went in, right? So let's talk about the type of risk that are there. So we have what we call a risk-averse investor, right? As the word says, a risk-averse is someone who tries to run away from risk, right? So if you think about some of our parents, we have now retired, we have retired now, you realize that they don't want to hear anything about you telling them that we can put money there and we can get that. They don't want to hear that. They want to just make sure that their money is in the bank, and they go to the bank and they are told that your 100,000 is there in the bank. That's what they want to hear, not about some funny investments or any lucrative investments. They don't want to hear about that. They are risk averse, right? So a risk averse investor is a type of investor that doesn't want to go into risk investment. So that type of an investor prefers less risk over more risk investments, right? So these guys, they don't want to hear about that, right? Okay, so a risk averse investor, in most cases, this investor would require an increased return as compensation for an increase in risk. So if they understand that there is a risk, they want to know why exactly should we go into this investment. So there should be a justification. The return that will come, they should justify why are we investing in such a risk investment, right? But they try to run away from risk. Then we have what we call the risk neutral investors. Right, so with the risk neutral, they don't mind what risk is there, but what they just need is where there is a higher return. So as far as there is a higher return, they don't mind what is the risk. They will go for that. That's what we call a risk neutral investor. Then we also have what we call risk-seeking investors. Maybe in most cases, when people are still young, 23, 21, they started working, they will be willing to explore and try to see different forms of investments. They can even be willing to get into forex trading. They can be even willing to get into option trading and so forth, right? So that would be an example of a risk-seeking investor. So this person actually believes that where there is a higher risk, there is a higher expected return. That's their belief. Even if they see that we expect a lower return, but in their mind, they are just asking themselves to say, why is it that there is a greater risk? So the fact that there's a greater risk for them, it's more than enough for them to justify why they're investing in such an investment, right? Okay, I'm gonna quickly move on to the next one. Right. Okay, now I'm going to talk about risk. Some of you have done statistics and you have done quite a lot of things in terms of these calculations. But I want to talk about, okay, I will explain the issue of expected return now before I go into the issue of risk. What is an expected return? An expected return is a return that has been calculated looking at the possibilities of uncertainty. So when you talk of risk, it refers to the uncertainty that exists. So if I tell you that we expect to get 20,000 Rand and 30,000 Rand in a certain investment, if that investment then goes down below that, maybe to a loss of 6,000. So if you look from where we were looking at 30 and let me just illustrate this using right. So let's say we have an investment that goes like this. All right. Then we have another one that goes like this. Right. So if you look at this, which one will be more risk in this case?
Blue one.
Which one?
The blue one.
The blue one. How many of you agree that the blue one will be the more riskier one? How many of you?
Yeah, I do, Bianca.
So you think the blue one? Okay, you all agree, right? Why are you saying the blue one is the more riskier one?
Because it goes up and down quicker.
Okay, so maybe this reflects
It's more volatile.
a return of maybe 2,000. Then there, as it goes 5,000, but as we go now, there's 100,000, right? But now when it comes to this one, so what you are just saying there is in terms of the return, I'm assuming that my return is this side here, right? So what you are saying, you guys, is I'm expecting a return of 2,000. Then all of a sudden from the same thing, I'm expecting 100,000. But if I look at the other one, it's maybe from 2,000 up until 12,000, right? So basically, you are 100% correct there. The one that goes like that, it's more riskier, right? Okay, now.
And the reason why I say is the blue one, sorry, because the end of it finished lower than the red one.
Okay, it's okay. From a financial management perspective, it's about the spread. So we look at the range of our returns, right? So if you look here, the range now will be from maybe 0 to 100,000, but the other one will be maybe from 0 up until to 30,000. So the range is a bit something that we can. There's no, remember, risk is a measure of dispersion, right? So the dispersion is very wide in terms of the blue one compared to the red one. Okay, we'll explain that as we go to other questions. Right, I'm going to quickly go through what we call the expected return. Let's look at what we call the expected return. So guys, when you are given probabilities like this, and you are given different returns, this is a country that we expect that the economy might be on average, but the probability of the economy being average, it's 50%. Then the probability of the economy being a boom, it's 30%. Then the probability of the economy being in a recession, we don't know, right? It's a question mark. Who can tell me what would be the probability of the recession in this case?
20.
20%, 100% correct. So what you need to know is your probability needs to add up to 100%. Your probability needs to add up to 100. So the balancing figure there, 100 minus 30 minus 50, so it's 20%, right? So that will be the other thing that they can do. They will give you probabilities and they don't give you for the other one. So you need to just know that your probabilities will add up to 100, right? So now, if you're given a situation like this, I know in your textbook, the formula says, how do you calculate expected return? Who still remembers the formula for expected return? I'll say R bar to reflect to expected return. How do you calculate expected return? It's summation of return times probability, right? So you sum up the product of your return times the probability times return, right? So what we are simply saying here is to get this, we are going to take 50% times 60, 16%. One thing that I just want to tell you is when you are dealing with this module, when you do risk and return, when you are given 50% and 16%, if you want to make your life easier, just to keep the probability as the probability a decimal, then you keep the return as a percentage as it is, to say 16. So I'll then say 0.50 multiplied by 16. Then I add the 0.30. Then I multiply by 20. Then I'll also add the 0.2. Then I multiply by -6. All right. So if I'm to proceed with that there, the 0.50 times 16%, it's 8%, right? Plus 0.3 times 20%. So you just say 0.3 times 20. You don't need to say percent. The final answer that we get will be a percentage already, right? 0.3 times 20, you get 6. Then you add 0.2 times -6. So we are going to keep that -6, right? So it will become -1.2, which simply means that 8 plus 6 minus 1.2. Just make sure that when there is a negative return, you always keep that negative, right? So 8 plus 6 minus 1.2. So we have 14 minus 1.2. Then you get 12.8. Anyone with a question with this? Any question, guys, or I should proceed?
No questions on my side.
Okay, thank you.
Good.
Right, so let's quickly move on. Let's quickly move on. I want to explain the issue of return now, of risk now. I'm done with the part of expected return. So now you need to listen carefully here. It's very simple. You guys, you should get all the marks on risk and return. But let's now go to where they normally allocate a number of marks, right? So we are now going to talk about the calculation of standard deviation, the calculation of variance, and this calculation of what you call the coefficient of variation, right? So I'm going to use the same information to calculate the following. I'll show you just now before I proceed. So I'm going to use the same information to calculate this. So I've already calculated the expected return. Then the next thing will be to calculate variance. Then the next thing will be to calculate standard deviation. Then the next thing, the coefficient of variation. Right, but what I'm going to do here, I don't want people to think about the formulas that we are given in the book. If you know them, that's very good, right? But in case you don't know them, let's just go the way that will be the best for you, right? So we are going to calculate the variance, standard deviation, and coefficient of variation. Right. So I'm going to use this information. It's only that my screen will be a bit small to clearly show everything that I want to do. So what we normally do when you are given something like this, I will also discuss about the formula so that those who are not comfortable with doing the table can always follow the formula, or where the question requires you to use the formula. But in this case, it will be multiple choice. So I think if you understand what I'm going to do here, that'll be great, right? So now I want you to understand something. You normally use a table that says return, then it says probability, then it says return times probability, right? I'm going to do it like this. Then after that, what you get here. So this part we have already done that part. So we took the return for the average, boom, and the recession. So the probability is 0.50. Then here 0.30. Then the next one 0.20. I hope you guys are able to see this, né? Is it clear to everyone?
Yeah, we can see.
Okay, cool. Thank you. Then here we have 16. Then we have 20. Then we have -6. Don't forget to use that -6, right? So now, what I'm going to do, we have done this part already. So 16 times 0.50, we said it's 8. Then 20 times 0.30, we have 6. Then -6 times 0.2, we got -1.2. So now let's add those figures, keeping in mind that there is a -1.2 there. So 8 plus 6 minus 1.2, we got 12.8. So 12.8 is what you call the expected return. Now, I just want you to understand something. This is what we call the expected return, right? So our expected return, we normally refer to as R bar. So our R bar is the 12.80. So this is our R and this is our R bar. Now the next thing that you need to do is to say R minus R bar, right? The return minus the expected return. All right. I could have squared it there, but let's just do it so that others don't get confused. Then I square it, right? Then eventually I'll take that R minus R bar. Then I multiply it by the probability, right? Okay, so just to do it once. Once we deal with the first one, we do the whole part, right? So let's go, guys. The step now is to say, let's take the 16. It's a return minus the R bar. So all these figures, they are going to be subtracted. We are going to subtract the 12.80 from them. Then we're going to square whatever we get, right? So I'm going to try to write what I'm saying here. It's only that my space is very small. But the first part that I'm going to do, 16 minus 12.80. What do we get? 16 minus 12.80. What are you getting, guys? Someone to just...
3.2.
3.2.
Yeah,
Thank you.
3.2. Yes.
Can we square that number, please? Just to square that number to say to the power of 2.
10.24.
10.24.
Yes.
Thank you. So what you then did was to say 3.2, then you squared it, then you got 10.24, right?
24.
Then the next thing now is to use that same number. Then you are now going to multiply it. Now the next step will be to say 10.24. Then you multiply it by the probability, that is 0.50. Let's multiply by 0.50 the probability. Then you get
5.12.
0.12.
Yeah,
Thank you so much.
5.12.
Can we do it for B, guys? Then we do for the recession, for the boom and for recession. Can someone just quickly take us through? So what I'm going to do, I'm going to do it myself. So it's 20. I know a number of you are doing it on your side, minus 80, right?
It's
20.
7.2. 7.2.
Thank you so much. 7.2. Then the next thing, so that's 7.2. Let's square that figure, 7.2 to the power of 2.
1.8 for 51.84.
51.84. Thank you.
Yes.
51.84.
84.
Right? Okay, then from there, we're going to multiply that by the probability. Okay, the probability of being boom is 0.30. Multiplied by 0.3. What do you get?
15.55.
15.55. Right? Then from there we go to the next one for the recession. Let's quickly go to the recession one. So for the recession, remember it's a -6. Are we together?
Yes.
-6. Then you subtract 12.80. What do you get?
Minus 18.8.
Correct, right? So you get negative
18.88.
Okay. 18.8. Thank you so much. Now,
you square
what
it.
does that? We now need to square a number. Guys, just to keep in mind, let's say you say -3, then you square it. So in other words, you're saying -3 times -3. It will give you a positive. number, right? So that negative will go out, right? So
Negative 3.
so it's
Answer.
18.80
Yes.
to the power of 2.
Mm.
You get
353.44.
353.44,
353.44.
right?
Mm.
353.44. That will be
44.
the return minus
The return.
expected return squared, right?
Mm.
So I normally have students asking me, where is our negative? If you have a negative figure, then you square it, that negative will go out, right? Okay, then from there, let's multiply by the probability, which is 20% in this case. So our answer times 20%,
70.69.
70.69.
69.
Now let's add these figures together. That is on our last column. 5.12 plus 15.55 plus 70.69.
91.36.
91.36.
36.
Okay, let me just clarify something quickly here.
Mm.
So what we have as the total of that last column is called the variance, right? Remember your formula for variance, it's square root of R minus, okay, is the summation. I was already on standard deviation, R minus R bar
Araba.
probability, right? So if you check here, our R minus R bar times the probability is the last column. So this sign, the summation, simply means that you are adding them together. So our variance in this case is 91.36. That will be our variance.
Mm.
Okay. Now, the next step now is to calculate your standard deviation. What is the relationship between standard deviation and variance? So if you remember, your formula says the standard deviation, which is SD, is the square root of some, in other words, is the square root of this. So it's the square root of the variance.
Yeah, square root of variance.
Right. Your formula says square root of summation of R minus R bar, and you multiply by the probability. But the standard deviation is simply the square root of the variance. So our variance in this case is
91.36.
91.36. So what do we get if we do the square root of that?
We get 9.56.
9.56, right?
Yes.
9.56. Okay. Right, so that's how you would calculate what you call the standard deviation, right? Then from there, I'm going to quickly move on to the calculation of what you call the coefficient of variation. Right? I'm going to move on to the calculation of coefficient of variation, right? I just want you to remember something. This is our expected return and this is our standard deviation, right? Who remembers how do you calculate coefficient of variation? And okay, I'm going to explain all these things to say what is the meaning of this, when do we use this, right?
Okay.
All right, so let me just quickly. Are you guys fine? Can I just clear my writings here?
Yeah, that's sorry. I've got a question there. Just on your variance, where on that formula where you say the summation of R minus R bar multiplied by probability, in the column, why have you squared it there? As we haven't taken anything for squaring there.
Okay, thank you so much. So if you check there, actually you are 100% correct there. Remember, this is R bar minus R bar squared. So we just took this number, then we multiplied by the probability. So this is R minus R bar squared. it should be expected. Thank you so much.
Yes, thank you.
Okay, but you definitely take the last column, right?
Mm.
But that was a very good contribution there. You noticed something very, very important, right? So it's R minus R bar squared, the last column, right? Okay, so let's quickly move on to the calculation of what we call the coefficient of variation. All right, I'm gonna just clear everything, but I want to leave, okay, let me just leave what I want. Right, I will explain to you guys when do you use the coefficient of variation, right? So the coefficient of variation is calculated as the standard deviation divided by the expected return, right? Which simply means that our standard deviation is 9.56 divided by 12.80. So what do we get? What will be our coefficient of variation in this case? 9.56 divided by 12.80.
0.7.
0.75.
75, right?
Mm.
Right, guys, so what is the coefficient of variation? A coefficient of variation is a measure of risk, but it expresses the risk per unit of return. Hence, we divide by the expected return. If you divide by the number of people, you get per person. So if you divide by the expected return, you get per percentage of return. So coefficient of variation is a measure of risk that expresses the total risk per unit of return, right? So in this case, we are saying for each 1% of return, the risk is 0.75, right? So when do we use coefficient of variation? So let's say you are given two different assets, and these assets, they do have a different expected return. So let's say this was asset A, then another asset B gave us maybe an expected return of 15. You then need to go further. You want to subtract to choose one between the two. So you then need to go further and try to get what we call the coefficient of variation because their expected returns are different. So that's when you use coefficient of variation, when the expected returns for the two projects are different, but you want to choose one between the two. Then if the expected returns of two projects are the same, there will be no need for you to calculate the coefficient of variation. You can make a decision based on the standard deviation. So in most cases, assuming that we are risk neutral or we are risk averse, would then go with the one with the lowest standard deviation because it is a lower risk. But if I tell you that the investor is a risk seeker, then you need to look at a project or an asset that is the highest standard deviation. That's what that person is looking for because it's a risk seeker. Right, guys, I think for today, I'm done with what I wanted to show you. But guys, if you have any questions, you are free to chat to Shelton, then we'll see how best we can assist you. I have taught this module and we have a number of people. We have got very good marks in this module. Some of the people that are in attendance, you might know me in person. If there's someone who knows me in person, maybe you can just share with others.
Hazard, I will. So Shadrack's helped me a lot with my financial maths and everything. So I've, my marks have been great, and he's very helpful, and it simplifies concepts and targets the stuff in the exams very well.
Thank you so much, Bruce Gibbs. Thank you so much.
Shadrach, are you doing a course thing on Sunday?
Yes, we are going to have a revision that will go between 4 hours to 5 hours. So we have a revision. You can speak to Shelton. You arrange with you, and he will tell you all the details. But I will present it myself, and I'll make sure that every topic will put everything that you are required to know. My belief is that after that session on Sunday, everyone should be able to go and get at least 85%.